We got an interesting new update from the Federal Reserve Bank of New York and a new study looking at household debt there falling for the first time in 6 years. Americans springing into action, I guess, with the stimulus that they got. And for more on this, I want to bring on Yahoo Finance's Brian Cheung. And Brian, it looks like whether or not it's the stimulus, it might be the stimulus, more Americans paying down debt.
Well, some pretty interesting data from the New York Fed. They have what they call the Consumer Credit Panel. This uses national data with some help from Equifax, the credit reporting agency. And the headline number was really that the amount of household debt, this is everything included, mortgages, car loans, student loans, actually fell in the second quarter, fell by $76 billion to, $34 billion to 14.3 trillion dollars as of June 30th. The most notable declines in those types of debt categories was in credit card spending. This is something that we had already heard from the likes of JP Morgan Chase, for example, where balances fell by $76 billion to $820 billion. But we saw some declines across the board in other categories as well. Something interesting, too, is that the delinquencies for those types of household credit also fell. So when you look at, for example, things like mortgage balances, the amount of forbearance actually had helped delinquency rates come down. The concern, though, is that the underlying fundamental health of these households is not that great, and that the forbearance was likely due to the CARES Act support, which means that if that forbearance were to be suspended, if the national moratorium on evictions were to be suspended, that maybe all of those households would ultimately end up foreclosing on their homes. So not necessarily a positive thing that the forbearance rates are helping those delinquency rates go down, but something definitely worth watching. Broadly, it does seem like, as you mentioned, Zach, some of the stimulus payments, for example, those $1,200 checks that went out in that first round of CARES Act funding likely helped people pay down their debt during the second quarter.
Yeah, the steepest decline in credit card balances that we've seen since the history of the data was reported. But also, we got an interesting update from the Chicago Fed, not to be outdone by the New York Fed. You know how these things go, saying that there are to be expecting some lasting scars here in terms of the unemployment rate here through the pandemic. What did they have to add?
Yeah, always a competition between these Federal Reserve banks dropping data on the same day. But the Chicago Fed, as you mentioned, with an analysis out saying that reshuffling of workers across industries, we were just talking about this with Indeed's Nick Bunker in the last block, but the reshuffling of where people are working actually could have a lasting scarring effect on the labor market. We've heard Chairman Powell talk about these types of concerns. The Chicago Fed estimating that the total effect of these changes to the labor market as a result of the COVID-19 crisis could be about 2% to the unemployment rate, which would suggest that it could be quite difficult for the Federal Reserve and economic policymakers to get the United States unemployment rate, at least as a headline, back down to that 3.5% 50-year low that we had seen prior to this crisis.
All right, the latest there. Again, we'll be watching when we get that jobs number tomorrow, right here on Yahoo Finance coverage beginning at 8:30 Eastern time.